Hey everybody, this is Jim at SP500chart.com. It's about 4:30 on February 20th, 2013, and we are going to look at the S&P 500 chart. I just realized I need to make this say copyright 2013. That means that I missed the whole year 2012. Oh well, so be it. Before we take a look, I need to remind you that SP500chart.com and this video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I am just a guy who draws lines on charts. And by the way, I want to say something. The goal of this video and the goal of SP500chart.com is not to tell you what to think, but to aid you in how to think. My wife and I homeschool both our boys. One of the reasons we did it is because we don't want to have our kids indoctrinated. We don't want to have them sent off to be told what they should be thinking. Rather, we want to teach them how to apply principles to where they can discover how to think. Because most of the people who do good in the world are people who know how to think, not people who've been told what to think. And I carry that through to the website and the video as well. So with that in mind, let's look at a 30-minute chart of the S&P. Here is all of 2013, starting right here with this big gap up on the second day of January. And we had been following this support line that has been working all year long, which today, I think, even though it's not by a technically significant margin by most people's definition of a 1% margin, just the same, it sure looks like it broke today, and any follow-through tomorrow would, I think, would certainly confirm that. So we're down about 1.25% in the S&P, the Russell 2000 down nearly 2%, and I think the strongest of the major indexes today was the Dow, but it was still down about 100 points. So I think you got to really kind of take notice of what happened today as being likely technically significant, especially when you consider what the Russell did. We may take a quick look at the Russell in just a second. What's interesting to note is after this red line broke, it looked almost as if we were going to bounce on this horizontal line that's at about 1514. But then it started to break too. So it was almost looking like for a while like we might be setting up a head and shoulders, and we still may be. But it looked really nice and tidy for a while there. So we won't really know if we're setting up a head and shoulders until we see if we start to get a back test, and I think it's fairly likely that we would. Because back tests are in and of themselves fairly likely, but I think we may also have the makings of the rationale for a back test to this red line. And part of that is this is the apex of our diamond pattern. It's interesting to note that our diamond pattern did meet its minimum target almost to the T on yesterday's close. And today, it's interesting to note that it gave all of that minimum target back today in one pretty much one fell swoop. Another thing that's kind of interesting is that we are getting very close now to the apex of our diamond pattern. Now, I'll be honest with you, I can't be too sure where this apex is, because the defining tops that would be instrumental in us getting a really accurate line right here, those tops don't all line up. So I am going with the first top and then the last one. And I'm letting the second one go a little above and the third one go a little below. Interesting to note also that if we get down to this level that is at about 1509, we may find ourselves encountering some gap support. So, and you those of you who may have forgotten, gap support takes place when the market jumps up and leaves people behind and they don't chase. Instead, what they decide to do is, if the market comes back to where I missed buying in at the end of the day on the 7th, because we had that gap up on the 8th, if the market comes back to that level, I will be a buyer there. So that's why I think there's a reasonable expectation for a bounce around 1509, 1510, based upon that is where I think the apex of our diamond pattern is. Here's our diamond in blue. Second of all, that also represents an area where likely to find at least some gap support. But if we do bounce there, do I think that means that you just go all in? I would say no. No, not at this point. I would rather see what the market has in store, because there are a number of reasons to believe that when you break a trend that has run this far uninterrupted, that you would expect more than just a little momentary lapse, that you would expect, I would expect, at least a test of this yellow line right here before it's all said and done. And if this were to break, then we could come on down and we could test some more significant levels of support that are nearly 90 to 100 points below where we are right now. So I'm not real excited right now about buying as things stand with this chart the way it looks. If we were to start a downward trend that establishes a recognizable channel, then I would be much more excited about going long on a break above that descending channel. But just to buy on an expected bounce, you be the judge. You have to do what you have to do. But for example, if we bounce at 1509, I don't really expect that 1509 to be a major support area, because this pattern's already done all we can really count on it to do. And since we've taken out this 14-ish level today, I would expect possibly even this to put up a fight on the return for a potential backtest to this red line. So to put it, I guess, just in the simple, you can see how it looked like this was running interference today. But to put it in simple terms, it looks to me like our red channel is in the process of breaking. And I only say it's in the process because 1519, 1511, it's about an 8-point margin. That's not enough to amount to a clear technically broken trend in my book. One thing I do want to show you and to remind you again, then I'll stop being so long-winded. And there are a couple things that somebody asked. I want to get to one of them today. But one of the things is, I mentioned we got over that brown line yesterday. You can't count on that line to be support when you return to it. And we proved that today. The market just came down initially, actually broke this little pattern that turned out to be one of those typhoon flags. If this had been descending, then I would have considered it to be a bullish sign. But instead we come up and then we just kind of melt up higher and break it, back test it, and then the wheels start to come off. So, the question came up by an emailer. When you have a bear flag, what do you expect from that flag to be the minimum target? And the answer isn't that easy. I would, and I'm kind of, I would say that if the bear flag is a clear ascending pattern, and it is a wedge, the general rule is you would expect it to at least have a target of where that pattern began to form. So, in other words, if we're looking at what took place between these two lines as a bear flag, between these two blue lines, and you break it, you would say, well, I would expect the move to at least take us back down to where this pattern began to form, and that would be around 1524. And you can see that the breakdown, the pullback, then the first initial move down was to 1524. But it's not quite that easy, because you have to take the larger picture into consideration too. So since we had that gap up yesterday, you could make the point that that just kind of leaves a lot of room for selling to continue. And it looked like we might get a little gap support here, but we didn't. So the answer would be, if you have a really long flag that's not really a flag, but if you have an ascending wedge, that, let's say, has taken 2 months to develop, and then it breaks down, I think you can reasonably say that wedge will likely take things down to where the wedge started to form. Let me see if I can find an example of that for you. Okay, here's a good example. It says Dragon Wave. They are well, never mind, what they do isn't important. But this is a 2-day chart. You can see a long-term wedge that developed back in the middle to late of 2010. Broke down, back tested, tried to get up for a solid back test, couldn't quite make it, came on down. So this would be a level that you would expect a minimum down here in the where are we, in the 4s. So you would expect this bearish rising wedge to create significant downside. But that's a long pattern. Interesting to note, by the way, that it formed a symmetrical triangle that made a continuation pattern. And if we measure the height of this pattern, let's see what we get. We would expect, after a breakdown of this pattern, a move to about $1.74. And look, there it made $1.74. I didn't buy there, should have, because it was an easy double after that. But anyway, that's a good example. But like a lot of things in chart reading, the context is very important. So let's see. By the way, we ended today, not that it's that important, right on this ascending line that defined the second half support line of our triangle, but I wouldn't put a whole bunch of faith in that line. I would put more faith in this apex. See if we get a bounce there, and all we can do at this point is if you're looking to liquidate long positions upon a back test of this red line, might be a good place to do so. But again, my goal isn't to tell you what to do, but just to teach you how to get a read off the chart for yourself. So there you have it. It looks like the nice upward momentum that started on January 2nd is now clearly in jeopardy of a reversal. Let's keep an eye on it for the rest of the week, and we should know a little bit more in a few days. And like I said, we may be entering a phase where instead of buying the dips, you sell the tops. Thanks for watching.